Welcome to Envisioned Broadcasting, the station designed to encourage, equip, and empower you for growth and success. Presents Women Emerge with Melissa Lambert, a show that shines a light on spiritual growth, health, purpose, and financial education. It's time to emerge and begin to live out your dreams, walk into your destiny, while making a difference in the lives of many.
Welcome to Women Emerge with Melissa Lambert. I am your host, and it's always an honor to come here to you again another Thursday. Happy Thursday, everyone. I'm excited. As we mentioned last Thursday, every Thursday in the month of September, we have our amazing Mr. Tony Chamblee he is the CEO and the visionary of Core Financial Partners. He's going to come in and share a lot of information when it comes to the IBC concept, the insurance, because this month is Life Insurance Awareness Month. But before we get started within the show, this show is being sponsored by Lambert Legacy Financial, powered by Core Financial Partners. Our goal is to teach the truth about money, engage in individuals and their families to think about and plan their legacy. Our focus areas are family, fun, and future legacy. This show will introduce you to leaders, experts, and motivators who share their journeys and their stories through personal and professional growth, knowledgeable tips, and lesson learned that will empower you to grow. It is time, y'all. It is time to grow your mind, your spirit, your brand, your business. And yes, we are talking about your finance. Today, we have the honor to have, again, Mr. Tony Chamblee. He normally does our every second Thursday, he does the truth about money. So this is the second Thursday, and we're talking about how to best use an IBC policy as your own bank. So IBC stands for Infinite Banking Concept. Just want to kind of touch base again on who Mr. Tony Chamblee is. He is the CEO and president at Core Financial Partner, also a certified IBC practitioner with Nelson Nash Institution. Tony believes in helping people grow their wealth through the efficiency of money with cash flowing assets over cash accumulation. Tony teaches his clients wealth outside of Wall Street and takes them through a unique process that shows how non-traditional money methods can accumulate into true and lasting financial success. Tony focuses on impacting his community through financial education and prides himself in helping individuals, families, and entrepreneurs employ the infinite banking concept. With Tony, every one of his clients' goals become his crusade. So please welcome to the show, Mr. Tony Chamblee. Welcome to the show, sir.
Well, thank you. I appreciate that, Melissa, and I appreciate you inviting me again. It's always a pleasure and a privilege to be able to share and talk and dialogue about something I'm so passionate about. And I know you've grown a passion for it as well, and that's why we are excited about continuously share this information to the public at large as much as we can.
Oh, absolutely, absolutely. And as you mentioned, I have grown a passion for this because of your leadership. It has allowed me to expand my knowledge on the IBC way. So I know that we always go into a little bit about Core Financial Partners, and I really want again to just give us an idea about our S's. You know, we talk about our mission with Core Financial Partners, which is to the four S's: survival, security, success, significance. Tell us why that has been the mission of Core Financial Partners.
Yeah, it's been the mission based off the personal acceptance where I was at one time, and I knew I needed to get better, and just doing my own due diligence and really getting after how money really works and the truth about money, I realized there's a stair step to get to where we all, ultimately want to get to. And so it just came natural to see that, okay, we all are going to be in survival mode. We all are going to be there, especially if you go to school, the cost to go to school and things of that nature. So that's survival, living paycheck to paycheck. Then it seemed natural to be able to say, okay, let's save some money up. Let's save a portion of what we make. And one of my mentors always poured it to us that pay yourself first. And we started doing that. And so we realized, okay, 6 months of your income will be an ideal place to be. You start off at 3 months and then you get to 6 months and you really are moving in the right direction when you're able to do that. And then from there, you take that savings and continue to expand it past 6 months to 12 months. So you let it grow. And now you're looking in your position to buy income-producing assets, which is now we call success. If you have income-producing assets a part of your portfolio, now your assets can make money for you. And this is where we started adopting the gain cash flow from Robert Kiyosaki. When you have income-producing cash flow, right, you have income-producing assets that create cash flow for you, you can now eventually dissipate in having to work for someone else or even in your own business. You work on your business, not in your business. And that's what that success really says. You free your time up now to go do some real incredible, exotic type of investments and building businesses and having a large portfolio. And then when you get to significance, Melissa, that's all about looking back, who is like me, who's wired like me, who's trying to get there like me, where's the winners that haven't won yet? Can I lend back to them the blueprint of what it got me here? And that's where you should be when you get to significance. You should be ready to leave a legacy. Leaving a legacy is when you pass away, everything you have done is still left behind as a blueprint for others to come behind you and do exactly this you did or better. And that's what CORE is all about. It's all about leaving a blueprint, leaving a legacy, and allowing those that are serious about their financial future, we leave them the blueprint to how to get to significance.
Wow. I love it. And one of the things that I love, again, about CORE is our core philosophy. And that philosophy, I feel that really stood out to me tremendously. More money doesn't get or keep you out of financial situations. Only education does. Why has that been the philosophy for CORE Financial Partners?
Yeah, that's been a philosophy because, once I got out of the traditional corporate structure and making my living that way, and I became an entrepreneur, I was around a lot of people doing really well for themselves. I mean, people that were making 6 figures, multiple 6 figures, and 7 figures, and most of us have come from modest background, right? We most of us never even seen 6 figures before. This is like 20 years ago. And so at that point in time, I watched all of us, rise up and do well financially. But as fast as we received the money, Melissa, we lost the money. We spent the money. We squandered the money, right? We didn't have any we didn't have a high financial IQ. And when you don't have a high financial IQ, you tend to not have the proper relationship and a proper respect of money. And so we believe when you get, the proper information and awareness of how money really works, which is you're going to get that by raising your financial IQ, which that's what financial education is, it changes everything. It's how sometimes it's how you look at the world versus how the world looks, right? That's kind of how money is. When you look at money in a proper perspective, you see it different. You value it different. You think a layer deep about your money. And that's what financial education does. Let me say this real quick. I'm going to make it quick, Melissa. Just come to me. The way I've received financial education is just, let me just share this real quick, was 5 areas. I learned that, how to make money in a different way. I come from a background of corporate America, so I was making money from a W-2. I turned it around and learned how to make money with a 1099 and in a corporation. So that right there, I can look at somebody's portfolio and how they make their money, and that can tell me what their financial IQ would be. The second thing I looked at is how you protect your money. I find that we put our money at too high of a risk when we have it somewhere where you can't move it and you can't adjust it on the drop of the dime. Like, you cannot do that like in a qualified plan. That says a lot. There's not a lot of protection there, because two things are going to happen in a qualified plan. You're going to lose money through the market going ups and down, and you're going to lose money on taxes on the back end. So that's number two. How do you protect your money? How do you protect your assets? How do you protect your portfolio? Here's number three. Number three, real quick, when it comes to financial IQ, is how do you budget? Do you live in a budget surplus, or do you live in a budget deficit, right? Do you know the outcome of every month based off what your must-pay bills are, including your miscellaneous that are variables, right? Variables are things that are not fixed every month. Do you know what you have to make every month to have a clearance of, okay, now I got this much, I can save 10, 15, 20% of my income. That's what I learned to understand that part. Number four is probably most important. Do you have control of all the money you're putting aside for the future, right? My mentor said to me, Melissa, if you cannot control it, you can't leverage it. If you can't leverage it, you can't gain wealth the way you desire and the way you will want to. Mm-hmm. Most of us are being trained on what to do with our money. It says here, when you're being trained, bring your money to me, give it to us, let us handle it for you. And that's like a qualified plan, a 401k or 403b, right? And so I learned quickly through financial education that I cannot separate myself from the control. Because if I can control it, I can leverage it. If I can leverage it, I can build wealth much at light speed when you can control it. So keep that in mind. Number four is keep control, keep it liquid, and be careful on who you trust with your money. And number five, where's your resources coming from? Where you getting your education from? You show me your mentor or who you follow, I can tell you where you're headed. I'm going to say it again. You show me your mentor. You tell me who you follow. It might be somebody you don't even know personally. You might be reading about them. You might be following them on social media. I can tell you your future. I can tell you where you're headed, right? Whether it's Tony Robbins or David Bach or Susie Orman, it doesn't matter who it is. If it's Robert Kiyosaki, who is that person that you've learned from? And here's the thing. Most of us only learn from what our trials and error, right? There's a world of information out there. And I'll end with this. And my mentor said this to me, Melissa, and it just made me dig deeper. He said, if what you thought was true wasn't true, how soon would you want to know? I'll say it again. If what you thought was true wasn't true, how soon would you want to know? And I was like, are you kidding me? So from 2007 on, financial education is just a part of my life now. It's like a daily activity of me diving into information, learning information, finding people that I know is on the track that I want to be on and getting to where they are as well.
Wow. I mean, again, you are tuned in and listening to Woman Emerge with Melissa Lambert. I have the honor again to have Mr. Tony Chamblee, the CEO and president, and he is the CEO, president, and the visionary of Core Financial Partners. We are talking about the truth about money and how to best use an IBC policy as your own bank. But Mr. Chamblee just dropped 5 amazing nuggets. And when I tell you, again, whenever you're listening to Mr. Chamblee, you must grab a pen and paper, and you need to sit and you need to learn. And just to hear these 5 amazing concept that you live by as well, how to make money in a different way. And I love how you mentioned you had to find that. You had to figure that out. And that was through a 1099 and a corporation. Then you talked about protecting our money. One of the things that we're not taught about the protecting. We're taught how to go make the money, but we're not taught about how to protect our money. And the biggest B that you just talk about, the biggest B that everybody needs to know is, how do I budget? I love how you even say, do you know, y'all, what you have every month, what you have to have in every month to make sure you make your budget work, and if you're over your budget or not. Do you know that? Then you said the fourth thing, do you have the control? All the money you have, you're bringing in, do you have the control of that? Or are you letting someone else control that money? Then number 5, where is your resources coming from? Who are you listening to? Who are you reading? Who are you following, right? Who's your mentor? And I love when you mentioned this last statement, because I believe that people need to know this and know it now. What you thought was not true. How soon? I hope I'm saying it right. What you thought was not true. How soon do you want to know the truth?
Yeah.
Did I say it right, Mr. Chamblee?
If what you thought was true wasn't true, how soon would you want to know?
Oh, if what you thought was not true, how soon do you want to know? I hope soon, Mr. Chamblee, because I believe that the truth must set you free. And I'm so thankful. I think we need to do just a segment alone just on these 5 and dive a little bit deeper. I know we're talking about infinite banking today, but I truly believe these 5 keys that you just dropped as nuggets are more than just nuggets, are something that if we can kind of look deeper into these 5 and begin to shift our mind, shift our lifestyle, it also will shift our financial future. So thank you for sharing these amazing nuggets, Mr. Chamblee. So we're going to dive deep into, how to best use an IBC policy as your own bank. So when it comes to IBC, Mr. Chamblee, what are the key benefits of using a infinite banking concept policy as your own bank compared to a traditional bank?
Sure. And I would say on the top of the list, it goes right back to number 4 out of the 4 ways to increase your financial IQ, which was control. And control is probably the largest factor on being most efficient with your portfolio, being most efficient with your dollars, your capital, right? Because once again, you can leverage it in infinite banking. You can leverage your money versus using it. Think about whatever money you're bringing in, how much of it would you want to reserve and still take care of your lifestyle by leveraging the money versus using the money and it's gone forever? How much of your income would you want to do that with? Would you want to do with 5% of it, 10% of it, maybe 50%? How about 100% of it eventually? We can show you through infinite banking to eventually get your whole income and all your expenses go through your own banking system. Right now, because we're not controlling it, we normally pass it through the traditional banking system. They're controlling it, right? The very same money we deposit into the bank as savings or put in our checking to take care of our expenses and things of that nature is the very same money that is lent to us when we need credit cards or car loans or mortgages and things of that nature. So control, to me, is probably at the top of the list when it comes to why IBC. What's the benefit of having IBC? The other thing is now, if you can control it, now you can leverage it, and now you can avoid from lost opportunity cost. Every dollar that you've spent away from yourself is gone forever. And every dollar gone forever doesn't have the ability to grow for you into the future, which is opportunity cost, the future value of your dollar. So when I think about it, if I'm going to go on vacation, take care of holidays and birthdays, take care of education, take care of business and business overhead and things of that nature, and I have an opportunity to leverage my money and not use my money, I'm going to do that every day. And in normal cases, Melissa, most people have about 3 to 5 different major expenses that happen throughout every year, each year. So that can easily be close to like 1/4 of your income that could be recycled and still grow for you. And now you're talking about becoming that, financial independent person. It would definitely happen. Over time, it would definitely happen if it's done properly. And that's what, to me, the advantage of having a set of and being involved with the infinite banking concept.
Wow. And I mean, one of the things that I like about how you share this concept, it makes it simple. And when we all sit and think about just the concept of what we're doing, it's something that we're used to doing anyway. We're used to giving our money to somebody, but this is a reverse. You're giving it back to yourself. So I love that, Mr. Chamblee. So when it comes to, again, we're talking about how to best use an IBC. IBC stands for Infinite Banking Concept Policy as your own bank. So how can you leverage your IBC policy to finance large purchases such as a car, a home, or even going for a family that wants to, use it for their child's wedding? How can we use that for those big, large purchases?
Sure, that's a great question. So I think we're going to put a bank thinking hat on when we do this. Mm-hmm. When you want to practice being a bank, you got to do what the banks do, not what they say. So you got to think from their point of view, not a client or customer point of view. So when you think about that, if you're going to use money, let's say you want to use it to purchase a vehicle, and you're the bank is going to say, look, okay, this is what it's going to take for you to borrow money from us, right? You have to be an honest banker. You have to have the credit worthiness at a regular bank, right? So you don't need that with become your own banker. You don't need the credit worthiness. However, you want to be an honest banker, though, and be good at paying yourself back. If we take the ownership and the responsibility and accountability to pay the traditional bank back, God knows we want to pay ourselves back. Because the interest that you normally pay them, Melissa, you're paying yourself. So now you're not only, and this is where a lot of people are not getting infinite banking. There's too many people out there talking about infinite banking, but how to use it is the most important part. You're going to pay back not just the principal of your borrowed money from yourself, you're also going to pay back interest as though you borrowed the money from a traditional financial institution because you set that up. You really are running a business operation when you are doing infinite banking concept properly. So if you're being charged 8% interest on your car loan at the traditional bank, you should be charging yourself 8% interest on your own bank as well. Our mentor, Mr. Nelson Nash, literally said, if you really want to be serious about this, call the banks and see, according to your creditworthiness right now, what would they charge you for a car loan? And then go and charge yourself for that. When you use your own money to buy a car, because you want to fund your account first, right, enough to buy your own car through your own monies. And now when you do that, you want to put together an amortization schedule like the bank would have handed you an amortization schedule. Here's your bank book. Here's your statements you have to pay me every month for like 4, 5, 6, 7 years. You do the same thing for yourself if you were an honest banker. And what you want to include in that accounting, you want to include the interest you want to charge yourself, right? The bank is going to charge you. I mean, the insurance company that we do this through, Melissa, they're going to charge us a flat 4%, but that's not realistic. If you want your money to grow, you want to go with the banks would have charged you. So if the bank's charging you 8%, 10%, 12%, at minimum you charge yourself that. So the additional interest outside paying back the principal with 4%, the other interest amounts go into your account. And now the rule of 72 works on your behalf, right? Remember, the interest rate you divide into 72 tells you how long it takes your money to double. So if the insurance company is charging you 4% for using their money, and you said, look, I'm going to charge myself an additional 10%, now you set your money to double every 7 years because 10 goes into 72, 7.2 times. So now you just created your capital to double up every 7 years. You have the control of being able to do that because you're the bank. You can say, look, I want to pay myself 20% extra. Your money's going to double now every 3.5 years. You have 100% autonomy to be able to do that, Melissa. That's what infinite banking is working at its best. When you know that you're in charge of the bank, you're in charge of the interest rate that has to be paid out, not the traditional bank. You have the control of that. Now you can grow your money as fast as you like.
Wow. Again, you are tuned into Women Emerge with Melissa Lambert. We have the honor to have Mr. Tony Chamblee. He is the CEO and president at Core Financial Partners. And we're talking about, on the topic, the truth about money, but we're discussing how to best use an IBC policy as your own bank. And I love how you make mention to still have the traditional mindset and be an honest banker. Still have the traditional mindset of, if they would have charged you 12%, why would you rob yourself of that same 12%? Be an honest banker, because if regardless of the matter, you would still pay them 12%. Why wouldn't you pay yourself? If we're giving you only 4%, but the bank, the traditional bank, will give you 12%, why wouldn't you pay yourself that to your own bank? So, Mr. Chamblee, I love the honesty about us really learning how to become better at our own money, controlling our own money, but also being wise with our money as well when we do borrow from ourselves. So what is the process for borrowing against the cash value of your IBC, and how does repayment work? I know you said we have to fund our bank first. So once we fund our bank, what is the process for borrowing against the cash value, and how do we repay ourselves back?
Sure. Great question. All right. As we said, you first want to fund it, right? You want to fund it and have enough capital in there to use it for your need, wants, and desire. And normally, you're not going to use it like an ATM. You're going to use it more like I would say, a major expense coming up, right? A major expense, once again, it could be a vacation, it could be a holiday, an anniversary, a business overhead, or a business startup. It can be a down payment on a home, or investors can use it for flipping, things of that nature. We can go on and on. Things that cost several hundred or several thousands of dollars. That's what you use it for. And once you fund it and you have enough in there to take care of a major expense, you could now make a phone call, right? And let me go back up a little bit. Some of us or some of you are in a position where you can literally fund it almost immediately because you have money stacked somewhere else. You warehouse your money in the money market. You warehouse your money in your regular checking and savings account. You warehouse your money in a IRA or 401k or a Roth. You can move that money over immediately. Just let the person that's working with you, the consultant, know that you have a dump-in that you would like to submit into this policy immediately, and you can almost use that money immediately. In about a month after it is all settled and in the insurance company account, you can borrow from it. You can borrow up to 92%. So remember 92%. Now you're ready to take a loan. Say you want to take, let's say, a $20,000 loan for whatever it might be. Say a wedding's coming up. You want to take a $20,000 loan. You can make a phone call, right, with anything, at least the carriers that I'm using, anything under 20, and different carriers, so don't hold me to this. I'm just going by the one that we primarily use. Under $25,000, you can make a phone call and get that process right over the phone done, right? They validate and verify who you are, and then they find out if you want it sent to the account that you're already contributing towards your account with, or a new account. You have a choice. And then from there, Melissa, they're going to now issue the process of you getting the loan coming to you. It normally takes a week, give or take about a week to come. If it's an emergency, it can be done within 24 to 40 hours. So, and there's a little cost behind that, a few dollars that they will wire the money to you. So in a regular case, a normal case, it would give or take a week. And when you put in the request for a policy loan, is what it's called, you can now just wait and see it show up in your account. It's that simple. You wait and see it show up in your account. The money's there. It should be real simple, real easy to get it. Once you get that money, you do whatever you want. Remember, I didn't say that they're going to ask you, what are you going to do with the money? They don't ask you about what you're going to do with the money. That does not come into play at all, right? And what I love about this versus a regular bank as well is that they're not going to check and see if you're worthy of the loan. your credit worthiness does not account here. It doesn't matter here. Also, they're not going to go and check your debt-to-income ratio. Debt-to-income ratio, if you're not familiar with that, is how is your debt versus your income. And they have percentage-wise, or if they're going to lend you money, your credit could be great. You can have a 800 score, but if your debt-to-income ratio is not proper, in proper order, they won't give you a loan. You don't have to worry about that here at all. And last but not least, what I love about once you get a loan, repaying the loan is totally up to you. Repaying that loan is a choice of yours. You have the autonomy to say, okay, I'm going to set up an amortization schedule and pay myself back, $50 a month or $500 a month for that $20,000 loan. It's totally up to you. You can even say, look, I don't want to pay anything. I have a new startup business, or just flip this home. I want to let it kind of marinate a little bit and mature a little bit and not pay anything for another year or two. You have the choice to be able to do that. Now, here's the deal. When you get any loan out, it is more so consider an interest-only loan. An interest-only loan says this when it comes to accounting: pay the interest at least every year, and you're going to win the game of banking here. Let me share why. When you have a loan out and the insurance company is only charging you 4%, your account is accruing at least 7% every year, Melissa. So if they're charging you 4% and you're accruing about 7% interest, give or take, you're having your favor is a terminology called economic value added. In the industry in finances, it's called EVA. We call it EVA. EVA means you have economic value added. That means your borrowed money is less than the growth that is happening inside your account. Your capital is making more money than the cost of borrowed money is costing you. So you have a 3% differential if you're paying 4% for that $20,000, but your $20,000 is accruing 7%. So that means that you have a net gain of 3%. And when you put yourself in that position, you're winning the game of money. And the thing about it, and hear me clearly, understanding that anytime you have a position to borrow money like that and have it still grow more than what the cost of borrow, you take that deal every single day. Whether it is a car note, whether it is a down payment on a home, whether it's flipping a home, going on vacation, take care of education, taking care of the kids, going back to school, stuff that they need. I can go on and on. I have a measurement in my business portfolio or personal portfolio that if I'm going to spend $500 in this plan and I see it coming at least 2 weeks out, I am going to borrow the money from one of my policies and keep that economic value added working for my money. Because once I pay that $500 to $5,000, whatever it might be, or $20,000 straight out of my account to them, and not use this system, how much money is that that $5 to $10 or $20 or even $200 is making me or making us? It's making us nothing. Please get that math. Get the accounting on that. You got because this is what a saver does, Melissa. They grow their money because they're trying to avoid paying interest. They took the Dave Ramsey class. I get it. That was me. I got the T-shirt. However, though, what Mr. Dave Ramsey does not do is teach us the value of the dollar. That capital has a cost to it. And right here, the cost is allowing us to grow it at 7% and only costing us 4%. You have a net gain of 3%. So using your money, you've lost 3% growth minimum every year for the rest of your life. But think about it. You're eventually going to pay the loan off in a few years. You get the whole 7% for the rest of your life. But once it's like, here we go. It's like you're eating the goose that makes the golden eggs. How many goose are you going to keep eating? That is not going to make you any more eggs in the future. And that's where, when I got this down, I'm like, what? You telling me this is not being taught in basic economics or basic accounting or basic, financial planning? See, this is what I've learned real quick, and I'm going to move on. We're going to move on to the next question. A lot of these advisors, and forgive me if that's you, I'm just being real about it. If you advisor, if you have advisor or you advisor, and you have all these people, they're smart people, Melissa. They're very smart. They've done their due diligence, study, and passed that test. That's not what we are. We work off wisdom. What we're teaching and what we operate from is wisdom versus financial smarts. Okay? So that's the difference. This is practical. This makes sense. Money doesn't have respect to a person or a thing. And we're living it with that, and we're living in that. So I just had to get that out.
I mean, I'm glad you got it out. I mean, and I want you to repeat that last statement. Money doesn't have what?
Money doesn't have a respect to a person or a thing. If you operate money and you have the right proper perspective of money and you use it with wisdom, right? Sometimes you can oversmart yourself, right? And some people can't wrap around their brain. Why should I borrow money from myself? Because the numbers don't lie. That's why.
I love it. I love it. Wow. Oh, my goodness. Mrs. Chamblee, I believe that you are truly a man that is blessed to share wisdom for us to know. Because I always believe when you know better, you can do better. So as you all are listening each and every Thursday in this month of September, we're on every Thursday at 6 p.m. Eastern Standard Time, but we also go live on Facebook and YouTube, the YouTube channel Women Emerge Network. That channel, we go live at 12 noon Eastern Standard Time on Friday. So please tune into both because you're going to get some information that, again, it's not been shared to you. It's not been told to you, and that's why you're in the cycle that you're in each and every day. And I say you, but I also mean me. I'm thankful that the wisdom Mr. Chamblee has, that he was able to share with me, that I was able to shift my financial future and be able to know that now I can say I have 3 banks, 2 for Chelsea, 1 for myself, and I'm going to be opening up my 4th bank shortly. So I'm so thankful again that we are able to bring this conversation to the audience. So can you kind of explain how your money continues to grow? Because we're talking about being a good banker, borrowing from yourself. But how does it continue to grow within the policy even while you are borrowing against it?
Sure, absolutely. I would love to. When it comes to becoming your own banker, one of the key factors to this creating financial independence for you and your family, it's not so much as it being an investment, because it's not an investment, it's a savings. It's because it's uninterrupted compounding happening with your money. You should write that down if you're under the sound of my voice. Uninterrupted compounding. A lot of people talk about compounding your money, compound interest, the rule of 72, things of that nature. But the real key factor is uninterrupted compound interest on your money. So many of us, Melissa, grow our wealth. We grow our savings. We grow our accounts just to spin it down, grow it, spin it down. Even the average person that saves in a qualified plan, we don't call it savings in a qualified plan, you invest in a qualified plan because of the volatility of the market. So you invest in a qualified plan, and so many of us have to borrow the money from a qualified plan, like a 401k or 403b or TSP. We have to borrow the money. You're starting all over again, because once you have grown your account to a certain degree with anything outside of infinite banking concept, you're most likely going to spin it down, a portion of it or all of it, and you got to now build it back up. You've lost the opportunity cost of your growth of your money. You got to start all over again. And I said this on a previous podcast. It's like starting a marathon race. You're going a quarter of the way into the race, and you got to go back and start all over at the starting line. When others that understand infinite banking are continue on, they're most likely going to finish the race strong and most profitable. But the person that got to go back, they're going to have to keep going back. Will they probably finish? Some of them will, but most won't. They won't finish the marathon. And that's how we have to look at our finances. We have to look at, our money in these accounts don't start over ever. It should start over, because you have a choice when you call the insurance company to get some money. You can withdraw the money, or you can get a policy loan. never, ever, right? And it might be isolated situations, but and that's in retirement. But before that, you never, ever want to withdraw no money, because the withdrawal money is gone and gone forever. You have to restart it all over again. And so we get a policy loan, and policy loans give you a lot of benefits. I think that's going to come up pretty soon, and what we're going to talk about in later on in the call. But that's the reason. Uninterrupted compounding allows your money to expand and expand at the most efficient rate with no interruption. You don't have to go back, start all over again, dip into it, start all over again. Some of us doing that with our regular savings account, our money market accounts, our qualified plans, our mutual funds. You got to cash in because something came up. It's so many things going on. Even in your emergency fund. Your emergency fund should be in here. That, everybody should minimum have $10,000 emergency fund, right? So when you have to go use that, which you will, emergencies will come up, you shouldn't have to separate yourself from those dollars ever. One of your policies, or within your one policy, it should be your emergency fund as well.
Wow. I mean, again, there is so much that we have to learn when it comes to this concept. It's not new to many. I mean, it may sound new to many, but it's totally not new to what's been happening. This is something that's been going on for years, that we were able to use something in this sort. It's just that the truth is coming out now. And I'm glad that Core Financial partners with Lambert, and Lambert Legacy Financial is also here to educate and to give us the truth and to help us to really indoctrinate. We've been indoctrinated for so long that we have to reverse that. So when it comes to, let's talk about taxes, because that's something that we want to kind of know. What are the advantages, right? So when it comes to the tax advantage of using an IBC policy as a personal banking system, what are the tax advantage for using an IBC policy as a personal banking system?
Yeah, this is an incredible way of having tax-free growth to happen in your account. And I'm not talking about tax deferred. This is tax-free growth through the entire process when done properly. One of the things that are happening in society with the average person is that we've been bamboozled with tax-deferred growth on our qualified plans, like a 401k, 403b, a TSP, even an SEP, which is a small business account. Well, with those accounts, you paying taxes on the back end. It's actually, it should be called tax postponed, not tax deferred, because in our mind, someone with a not so informed mind about finances yet, you're looking at it like you're not paying taxes on this money. And my mentor said to me some time ago, Melissa, he said, would you want to pay the taxes on the seed of something or the harvest? Think about a seed. A seed is like it's barely in your finger, right? Do you want to pay taxes when something is at a seed level, or do you want to pay it when it's at a harvest? Like the harvest could be your whole neighborhood, right? Which way would you rather pay taxes on something? The harvest. I mean, on the seed, right? It's
right.
It's almost like a no-brainer question. A no-brainer is take your brain out and you still know the answer to it. Well, that's what that is to me, right? But we're not told that. When we get a new job, we get a job, you automatically enrolled into it. You have to opt out. So you're already being put into investor position, and you don't even know anything about being an investor. Nope. Because to be in a 401k or qualified plan, your money's on the market, and there's a lot of volatility on the market through all of this process. And then you got to learn about taxes later. That, you can't touch this money until 59 and a half without being taxed, or without being having early penalty fee, right? So that's where we move over to a IBC policy, right? Being in an IBC position, become your own banker. You don't have to worry about any taxes. Write this down if you're under the sound of my voice. Loans cannot be taxed, no matter how much it is. I'm going to say it again. A loan cannot be taxed no matter how much it is. So the reason it works the way it is, that's why Mr. Nelson Nash is a genius. He was obedient on his knees to listen and then go to work and execute, because you can have as much money in there and borrow against it and still live your lifestyle without having to pay one penny in capital gains. The money when the money goes in, though, is already in that situation. You already pay taxes on the earned dollar, because you pay taxes on earned money, then you pay taxes on the growth of money, but not in this situation. We're going to see our money grow and multiply and still use it without paying one dime in taxes. And then here's where the beauty of this is. At the back end, Melissa, when you've used all this money to your most your max capability, and then you have a death benefit on top of this. How about the death benefit is tax-free? You've used this money and grown your money in here, and it buys more death benefit, because inside the structure of an IBC policy being done properly, your death benefit is not level. It's not going to stay the same. 10, 20, 30 years from now, it done 10, 20, 30 times itself. So now you pass away, your family getting all those dollars, right, tax-free as well. So you can't get any better than that. Here's what I've learned through, once again, doing this as long as I have and doing some accounting on this. If someone has money in a mutual fund, and that's what 401ks and TSPs and 403bs are, is inside of a mutual fund, or they have their money in some sort of portfolio like a Roth or whatever it might be, they have money in these accounts, they got to pay taxes on that money. Only one you don't pay taxes on the back end is a Roth, right? So you paying taxes on this money and fees. You definitely pay fees on a Roth, just like you do on the other one. You just don't pay taxes. Do you know that's equivalent to, if we're getting 7% on our IBC policies because of the dividends and the interest, when you put it all together, let's just average it out, around 7%. Do you know that's equivalent to what people are getting on the market, around 12 to 13%? Imagine if you can get 12, 13% growth on your money, right? And it's impossible to lose any money. There's no volatility to it, right? Where will your money be in the future? But that's the equivalent of setting up an infinite banking concept policy. You don't have to pay taxes. You don't have to pay fees. And because of that, you know, you can predict what your money is going to look like. That's why you can set this up for retirement as well. So the difference is in what you're getting out of this with no taxes is night and day. It's night and day. And the thing about it, when somebody's comparing this to a investment, I caution you not to do that, because this is not an investment. Even though it can grow nicely, it still grows like a savings plan compared to your savings plan or your money market or your CD. Compared to those things that you normally have in a bank that's protected through the FDIC and you can't lose principal and all that, right? So compared to that, because that's what this is. That's the comparison. We take that money, borrow from it, and then we go do some investments to make billions from our money or make wealth from our money. So hopefully everybody's clear with that, because the language out there is like you compare it to investment. Well, I get 10% on my returns over here, or I get this. No, you don't compare it to that. What do you get on your bank account, on your savings account, your money market account? That's the comparison. And tax-free? Wow. Oh, now we can look at it that you're getting gains like a regular investment account, but it's still not an investment account. It's a safe haven. It's a warehouse. We go borrow from it, then we go invest on the market. We go invest in real estate. We go invest into crypto or business startup and things of that nature. So that's where I find that a lot of people are misled, and I want to make sure that we know the facts about this and we get the truth about this so we can now go and set our families up and our businesses up properly.
Wow. Again, you are tuned into Women Emerge with Melissa Lambert. This show is being sponsored by Lambert Legacy Financial, powered by Core Financial Partners. We are dedicated to bringing financial awareness to communities through the infinite banking concept. And that's what Mr. Tony Chamblee is here to share. And what an honor it is to have the CEO and the president of Core Financial Partners really diving in and giving all the concept that we need to understand truly how to make this IBC policy work for you. We teach the truth about money, empowering individuals to think about and plan their legacy. Our vision is to be a beacon of financial education, transforming lives by instilling knowledge and confidence in financial planning. We aim to create a community where everyone is equipped to build and sustain a legacy for generations to come. I know that we're wrapping it up, Mr. Chamblee, and I know that we have only about 5 more minutes left. I really still want to ask you just one quick question, and then I want you to kind of share with us how can we connect back with you and give us some tools that we can kind of, on our spare time, start learning about this thing as well, this IBC policy. So one of my last questions for you is, and we're going to dive into this more on Friday. So the last question I have is, in what situations should you prioritize borrowing from your IBC policy instead of using savings or traditional credit?
Yeah, that's a really good question. It's considered a major capital purchase that you're using it for. A major capital purchase is qualified this way. If it's something that you have to save for in order to do that thing or have that thing, a need, want, or desire, right? Because your monthly income after taking care of all your responsibility doesn't have enough left over to take care of that thing. So if you normally go into your savings for something like a vacation or a holiday, a dinner party or something that you're doing, or maybe education, whatever it is, you're going to your savings or you're financing it. You're getting a note for it, or you're financing it from the bank, which is it could be a credit card or whatever it might be. If you have to use any other sources outside of your cash, right, because it's costing several hundreds of dollars or thousands of dollars, that's when you should use it. And to me, it should be everything that's planned. If it's planned and you have a window of a week to 2 weeks to plan for it, to be able to receive the money from your policy alone, then that's what you want to do, right? So I know I use a measurement of about $500, right? So if anything is going to be more than $500, I want to get a policy loan for it if it's planned and it's 2 weeks out, at least 2 weeks out for me to get the loan, and I'll have no problem. So if I'm planning a vacation, I'm already on top of that 6 weeks ahead, maybe 4 to 6 weeks ahead to go call for a policy loan. But if holidays coming up, and Melissa, we do Christmas big around here. So whether it's a dinner party or it's an event we having, I'm already getting ready for that a couple months ahead, right? So anything 2 weeks or longer, because it can take anywhere from a week or so to get that loan. So and then you want to make sure you're not playing it close. You should be getting the loan from your policy. Just know what your benchmark is. My benchmark is 500. So your benchmark in the beginning could be 300. It could be less than that, or it could be more than, because your income monthly dictates that I can take care of something like this with extra money that I have at the end of my taking care of my responsibilities. So you got to measure all that, and that's something where a consultant working with you can help you decide what is your benchmark on the minimum you want to make sure you're calling the loan for, because to be honest with you, every dollar can have loss opportunity cost. So it can be lower than 500. Yeah. That's just mine. And so keep that in mind when you're speaking or working with someone. Dictate or determine or look at and project what's going to happen in your first year that you can be using your policy for. I would look at 2 to 3 things that I can be using my policy for if you have money to move over right away, or you have enough going in monthly to you be able to use it for maybe a year from now to go on vacation with that money. So kind of look at it, project it, and then plan for it, and you'll do well and become your own banker.
Wow. Awesome. Well, we only have 3 minutes to go, Mr. Chamblee. What are the websites that they need to kind of follow and kind of learn from?
Yeah, I think the direct one to go to right away, it leads you to everything else in our website, is learnmorewithcore.com. Learnmorewithcore.com, right? If you go there, there's a video series there that I think we're up to like 16 videos in there. And the average video is only about 2 to 4 minutes long, right? And then we have one that I just uploaded to the series that it goes over, how and why use this versus an IRA or 401k or something. That was a great one. That one's the longest one. It's about 30 minutes. I will watch that one for those that are putting money in IRAs and Roths and 401ks and TSPs and 403bs, things of that nature. So go watch that. And also our website, the home website is corefinancialpartners.com. And there's other videos that's rotating on the homepage that you can watch that are incredible videos. We have a video that we just loaded up there, Melissa, the Rockefellers video. I love that video. It's only about a minute long, but it's powerful. Mm-hmm. So I will go watch that with some other videos as well. The last video I would suggest that you go and check out is coredebtstrategy.com. Coredebtstrategy.com. If you're a person under the sound of my voice that you want to get rid of your debt or pay your mortgage off early, things of that nature, and be most efficient with your dollars, we could show you, do a short video, how you can do that, why you should do that, and it goes through all the details, and you'll be real clear how just that entity of getting rid of debt, how IBC can be used. Remember, infinite means it doesn't have an end to it. It doesn't stop. It's unlimited amount of things you could do with infinite banking. That's why you want to have a coach/consultant. That's what we provide at Core Financial Partners. And Melissa, we're so happy that you're on board, and you've learned this to the degree that you're now a consultant to many, many people out there. It's going to make a difference in many, many entrepreneurs and families' lives because of it.
Wow. Thank you again, Mr. Chamblee, for always coming through. I truly, truly, truly appreciate you guys. Tune in again every Thursday at 6 p.m. Eastern Standard Time. Mr. Chamblee will be here every Thursday this month of September, so don't forget to come to us on Thursdays at 6 p.m. Eastern Standard Time at womenemergeradio.com. You can follow me also on Facebook at Melissa, Mellisa S. Lambert. Thanks again for tuning in, y'all. Women Emerge with Melissa Lambert. If you found this episode helpful, share, like, and comment, and share this with a friend, because I truly believe that it is time for us to raise our vibration on understanding the truth about money. Thank you so much again, Mr. Chamblee, for really, truly sharing with us how to best use an IBC policy as your own bank. Until next time, y'all, take care, take charge, and continue to be great. Bye for now.
Thank you for listening to Women Emerge with Melissa Lambert, where Melissa speaks with leaders, experts, and motivators who share their journeys and their stories through personal and professional growth, knowledgeable tips, and lessons learned that will empower you to grow. Follow Melissa and Women Emerge Network on Facebook, Instagram, and TikTok at MELLISASLAMBERT and at Women Emerge Network, and visit www.womenemergenetwork.com. Remember, when you know better, you can do better, especially when God is for you.